Can bank regulation prevent financial crises? Have you ever wondered if the rules governing banks can really stop financial disasters from happening? This is a question that many people ask, especially in light of past economic downturns. Bank regulation does play a role in reducing the chances of financial crises, but it is important to note that it cannot completely eliminate them. From a Republican viewpoint, which tends to favor free market principles, the focus is on sensible regulation that supports market discipline. This means that while rules are necessary, they should not be so strict that they hinder economic growth and innovation. The main goal of bank regulation is to ensure that financial institutions have enough capital and liquidity to handle unexpected shocks. For instance, capital requirements requiring banks to hold a certain amount of equity based on their risk-weighted assets. This helps banks absorb losses during tough times. Liquidity requirements, like the liquidity coverage ratio, ensure that banks have high-quality liquid assets to meet short-term obligations. These regulations promote sound risk management and transparency, which can help identify vulnerabilities early on. However, regulation is not foolproof. Take the case of Silicon Valley Bank in 2023. This bank faced failure due to poor management and gaps in regulation. It was not subject to certain liquidity requirements that might have encouraged better risk management. This shows that regulation should complement strong internal governance and market discipline. From a conservative perspective, the aim of regulation is not to ensure that banks never fail. In fact, failure can be a natural part of capitalism that helps discipline bad actors and allocate resources efficiently. Instead, the focus should be on creating a framework that minimizes the chances of widespread crises without imposing burdens that limit economic dynamism. Overly strict regulations can reduce credit availability and increase costs, pushing financial activities into less regulated areas. This can create new risks. Practical examples of this approach include advocating for regulatory reforms that balance safety with growth. Recently, federal regulators have eased some post-2008 banking rules, reflecting a belief that the financial system is stronger now. Republicans often support measures that promote a healthy banking sector, which in turn supports business and job creation. In summary, while bank regulation can help prevent financial crises by encouraging prudent risk management, it cannot eliminate risk entirely. A Republican approach emphasizes limited but effective regulation that protects the financial system while allowing for the natural process of bank failure when necessary. This balance aims to maintain economic stability without sacrificing growth and innovation.